Alan, Darby, Jacqueline Martinez. This is the Buyer's Boardroom. Learn the most about who you are today and where you want to be after.
All right. Welcome back to the Buyer's Boardroom. How's it going, Alan?
It's going awesome, Jacqueline. Good to see you. It's been a great week.
Good to see you too. I know, exciting day. We've got big deal closing today.
Yes,
Love that on a Friday.
always wonderful when you end the week with a deal closing. So it's a long
Yeah,
journey to come to a successful conclusion.
absolutely. So today's episode, we are getting into the 1099 model, pros and cons of that. Um, And I think what's important here is how it can kind of pop up late in the game for advisors when they're thinking about going to market, and they may have advisors on the team that have that 1099 independent affiliation model where essentially they're free to leave with their clients, and they may not realize how that can really impact their valuation down the road.
Yeah. It's a very it's somewhat perplexing when I get them on the phone and we call them like an OSJ model,
Right.
and they think that they've built a business enterprise that has, so say it's a $10 million OSJ and they've got 10 or 12 independent advisors who are 1099 advisors, and the owner of the OSJ is seeking to monetize the business. And I have to be the bearer of bad news sometimes to let them know that the value that they have in that current construct isn't what he thinks or he or she thinks it is. So I think it's a great topic to focus on. Not that we're trying to say having 1099 advisors is bad, but it certainly, to your point, impacts your ability to monetize. And so that's what we're
I bet that
talking about.
surprises people sometimes too,
Yeah,
right?
it really does, and
Yeah.
we're super excited to have Nate Lenz, who's the co-founder and CEO of Concurrent, which is a $7 billion hybrid RIA, and they've somewhat solved for this in a very elegant way. So as we go through our thoughts on it, I think Nate's a perfect person to have and give his opinion on how Concurrent has addressed that and helping solve this challenge.
Absolutely. Yeah, I'm excited for him to talk through how their structure not only addresses that part of it, but also equitizing next gen so that it can really be a firm of the future and have that longevity too.
Yeah, yeah.
Well, before we get into that, I think it would be fun to talk about a theme you and I have been talking about offline around just the egos in our business that pop up in the
Yeah.
deal process, and specifically seeing that we've been so fortunate to bring a bunch of deals to market in the recent month or so, and noticing a theme of firms that have done a lot of deals in the past. So on the buy side, they've completed a lot of acquisitions, they're in a good groove, it's a well-oiled machine, but sometimes what comes with that is the executives that are representing the buyer firm, that they jump on the calls, the introductory calls with the seller, and it's very evident that they just plan to wing it. They've
Prepared.
barely read the materials that we've spent hours and hours putting together. Asking questions that are easily,
Yeah, like
available
where are
to
you
them.
located at? Like it's
Yeah, where are you located? Where do you custody? And that's like, kind of the harmless questioning, but sometimes even a level deeper around arrogance. And it can just be so off putting and really, really end the conversation right there, which is so unfortunate because the firm overall has so much to offer and would really be a great fit.
Well, I think that's a great point because the firms that have been highly successful, the serial acquirers, they've done 20, 30, 50 acquisitions. I think after a while, you can start to feel your own groove and think, we really got this and I don't need to prepare like I used to years ago when we were slugging it out, on first trying to get our first few acquisitions done. We don't come to the table with the same empathy that we might have had before, and it shows. And even though, as you mentioned, the buyer, their firm is awesome. They have a ton of resources, lots of things that the seller would be super interested to hear about. They can't get past the personality of the
Mhm.
unprepared, and use the word arrogant. I don't think they mean to be arrogant. It just comes across that way. And they tend
Mhm.
to, rather than get on and, spend some time trying to get to know the person that they're talking to, they just start firing away with questions and it's sort of off-putting, and it puts the seller back on their heels. So you mentioned this recently at the Future Proof conference when you were speaking in our guidance to buyers. We spend our time advising sellers, but we work with so many buyers, we can see the differences in how they approach things. And we want to sort of tell them without naming anybody, hey, you may want to pump the brakes a little bit and get back to your original roots and just appreciate who you're talking to, that this is a firm that's going through this for the very first time. They don't know what to expect in a lot of ways. And, spend time studying the materials that we prepare for you, and all the things that we've put together, hundreds of hours of time into why they're here in the first place. Show up, act prepared, and be nice. So
Right. Yeah.
anyway, we'll get off.
No, it's yeah. Not only will it keep you in the mix, but it also helps when it comes time to picking. And so often we see firms go with the buyer that's not the highest bidder, but it's of course the overall package. So many things that go into that, but that personal connection is such a key part of it.
100%. If we are right, and we both think we are right, that culture is the most important thing, that human element, you can't escape it. You can put forth an incredible economic offer, but if the perception is my life is going to be miserable if I have to put up with people like you, speaking to the arrogant buyer, then they're going to say no to that opportunity. And this is where like an opportunity, this is a little off topic, but the smaller regional firms, who used to, this is who the big national used to be, they put such an aggressive, and I don't mean like in a bad way. I mean, they're pouring the love on them, and that shows up, and it makes a huge, huge difference. Okay,
Yeah.
so let's.
Well, it feels like we could do a whole episode on that, but we won't.
Yeah, maybe we can include that. Okay, so let's talk about when we talk about the 1099 model, and this could be a firm that has built their business entirely on recruiting 1099 advisors. It could be a business that has a majority of W-2 advisors, but then they have like a smattering of 1099s in the mix as well. Why can that be problematic in terms of evaluation? Okay, so here's the easy way to understand this. The valuation is tied to EBITDA. EBITDA is tied to the client contracts. And in a 1099 relationship, let's say I'm the owner of the business, and I have 10 individual 1099 advisors. They each have to do $1 million of revenue. So in aggregate, the business is doing $10 million of revenue. I may be charging them a fee, let's say, to provide them services like compliance, back office support, technology, things like that. But the 1099 advisor actually owns the client. I don't. And therefore, a buyer, when they look at that business, they can't ascribe a value to that business because the owner of the enterprise does not own the actual client relationship. And
That's right.
So you could be doing $10 million in revenue, and your portion, whatever your services would be, might be 2 to 3 million, whatever you're charging the advisors in my scenario here. You can't even monetize that because
those advisors are free to leave. I think sometimes there's the nuance around just how is the advisor paid. We don't necessarily mean 1099 versus W-2 from that standpoint, but more about has that advisor signed restrictive covenants that or not, that they're free to leave with their clients if they want to. And that's what we're really isolating, just to be clear.
That's right. Yeah. That's right. So, and then another problem that is presented by the 1099 model is that, buyers, when they are going to acquire a firm, we often get 1099 built organizations come to us and they'll basically be saying, well, why don't we all just, right before we sell to the buyer, we'll all just join together in like a step transaction before the sale. And then that way we can capture all the valuation. Well, the problem with that is that you're not really a unified firm. Each individual 1099 operator typically flies their own flag, so they're operating under their own brand. They may be utilizing central services from a tech perspective, but they have different client experiences. They have different investment theories or ways of implementing. And so when you look at that, and I'm using this $10 million scenario here, it's really 10 $1 million businesses, not one $10 million business there's a unified, comprehensively, or let's say integrated practice. And so
Right.
a buyer, a smart buyer, let's say, they're not gonna believe you if you come to the table having just transacted, trying to jam all these 1099 advisors together, and then immediately
Yeah, they'll see right through that.
they'll see right through it. Yeah, and
Yeah.
when we've had these scenarios before, and we call the buyers and we're giving them the scenario, we've often heard them immediately go right to that. Well, is this truly an integrated business, or are they just trying to scrape this delta in valuation by coming together immediately before our transaction? So,
Right.
and then alongside that, when you have all of these individual business units operating individually, who knows what the legal risks are, the business risks are? We find often that central OSJ, they're not familiar with the inner workings of the 1099's business. They don't know their P&L closely. They see the revenue, but they couldn't really tell you how, the operating expenses and structure of their independent 1099 advisors. And so
Right. There
look at
could
it.
be like unknown HR legal risks that are in each of those little silos because they are all hiring their own teams underneath that. There's no consistency. Um, all of those things. It just opens up the risk beyond that the RIA firm doesn't own the client relationships. It's also unknown legal risk there of how each individual business is running things.
Yeah,
So I guess the lesson there really is if you're thinking about adding advisors to your team, is to really consider the pros and cons of how you set them up from the start
yeah.
and finding a good balance of the autonomy that's attractive to advisors, but also the long-term value creation and what's the best long-term play.
Yeah, we totally get it at why you built the 1099 model, because frankly, it's easier. It's easier to attract an advisor to join your organization when they're a 1099 advisor versus a W-2 employee. It's a tougher sell, if you will. And so
Yeah.
we understand why some business builders pursue recruiting those 1099 advisors. But when I encounter someone, sometimes I get someone on the phone that is very early in the process and they're talking about building it, and I highly encourage them to pivot and fully embrace the W-2 construct, because it might be a tougher build, but for you to capture any valuation as a result of all your efforts, you're going to have to convert those 1099s to W-2 ultimately. So why not start and build the business that way and build it in an integrated fashion? So,
Mhm.
so that kind of leads us into the next area, which would be like, what is the remedy? If you are one of these firms and you've built this 1099 practice, 1099 based practice, or you have a W-2 practice with some 1099 advisors in it, what do you need to do in order to solve the problem? There's a one simple way that I think is probably the best approach to it. We've referred to it as a buy down strategy, where effectively you go to all of the 1099 advisors, and you're asking them to exchange um, revenue for equity in the parent company. And so it's like this equity swap, if you will.
Kind of cashless transaction, but allows them to become shareholders. What comes along with that is signing all the normal restrictive covenants. So now the clients are clients of the firm, you're a shareholder, and the math can work out such that, all else equal, revenue is the same percent or the same level that it was, that they're able to take home the same net pay, but overall the cap structure is cleaned up and everyone's locked up with the right agreements, and overall they can benefit from a much higher valuation
Yeah,
if the integration part is
because if you look at
there.
the value of the individual 1099 advisor's business compared to what it would be if they did integrate, and without any increase to revenue, really no increase or changes other than that exchanging their ownership in their 1099 for ownership in the parent entity, let's say. there is definite value creation. We've seen it to the tune of 2 to 4x and even a
Absolutely.
difference just in the merger itself. But the key is the key to achieving that is it has to be a truly unified firm. So in a buy down strategy, unless you guys have been operating as 1099 advisors on a shared tech platform, shared client experience, shared investment platform, all of these
Branding.
things. Yeah.
Yeah.
You need to get to that point before the buyer is going to believe it's an integrated firm. So you likely need to do this if they were all operating independently, as we described previously. You would do this exchange and then operate. You need to migrate towards an integrated model over a period of time, at least a year, I would think, maybe longer,
Right.
so that there is indeed this unification of the business, such that the buyer, so that it's true, and that the buyer believes that, okay, we're not really buying 10 different businesses, we're buying a single business with everyone on the northbound train, so to speak.
Right. Yeah, it's really interesting. I know we went through one of these recently, and there's some real challenges with the buy down strategy and getting all of the individual advisors on board. And sometimes it's really an inverse relationship to like of their size and the fear that they'll have of being part of a bigger organization.
Yeah.
Smaller advisors sometimes just more nervous about it. What are they giving up? That sort of thing, and really working through the emotional element of that part of it, like with any transaction that we deal with. But um, I think as the RA owner, just being okay with letting some advisors go through that process if they're not on the northbound train, and really, like any one single advisor may not move the needle that much given how much EBITDA they really were generating for the firm anyway on the payout structure.
That's a great point. Like if going back to my scenario where there's $10 million advisors, when you as the owner are attempting to do this buy down type strategy, I think you need to go into it anticipating that everyone is not going to join, and so, but when you do the math, even with losing a significant amount of the 1099 advisors, whom which you have no equity value in, it's not as if
Right.
you might be losing revenue, but you're not losing any value for them to depart. You would still end up in a much better economic outcome, and not just you, but the 1099 advisors who would be participating in this with you. So, but it has to be integrated, and there are
Yeah.
buyers.
Well, let's go back to that. I know you were saying like a 1 year kind of let everything settle in once the legal structure has changed. Tell me more about how you see that first year going, and like what really moves the needle for this to be viewed as a unified enterprise now.
Yeah, well, certainly everyone's on one ADV,
Hmm.
unified brand, so we don't have 10 individual brands. It has to be a unified tech stack and operating system, let's say. And then probably, and most importantly, would be a unified vision on the client experience. Meaning you can't have half the 1099 advisors who join, they view themselves purely as asset managers, and the other half are holistic financial planners. There's got to be an agreement on, okay, as this unified firm, this is our role as an advisor to our end clients, and we're all doing it in a similar fashion. There's not huge discrepancies in the client experience delivery from one office to the next, particularly on the investments piece. We don't have 10 totally different investment philosophies and implementations going on. So it's a combination of all of those things, and it's a tough ask, right? There are different, these 1099 advisors tend to do things in their own fashion, and they're quite proud of it. And so getting everyone to agree that this is how we're going to express ourselves to our clients and deliver services, it's a big lift, but one that's very much worthwhile. But you can't have huge differences in all of those things and try to present yourselves as a unified, integrated business. Those have to be pretty tight. And I just think that takes time. It could take a year, it could take 2 to 3 years, but well worth it in any regard.
It does. I think also like there's often margin expansion that comes from unifying all the vendor contracts, all of the benefits offerings, all of those things, and letting that profit go to benefit all of the advisors. So they're getting something in exchange for the work of all the change that happens.
No,
But it really aligns everyone to that.
absolutely right. There's redundancy embedded in those 10 individual practices. There's just wasted dollars because everyone has to have maybe their own compliance consultant or their own accounting firm or their own law firm representing them. Well, when you come together, all of those things can be centralized, and therefore you can create that excess margin that can be devoted towards improving everyone's life, in terms of improving the tech stack and all the other things that these larger firms are starting to really, let's say, extend their lead over the pack who aren't making those types of investments. So
That's right.
it's a great move. So all right,
Yeah.
so this is kind of a segue into my interview with Nate, which there are certain buyers who are more comfortable with this type of scenario than others. And that's something that we've experienced when we're working with buyers and onboarding them into our system. This is definitely one of the things that we try to tease out is, would you be willing to, go through the steps with a prospective partner who's trying to solve for this challenge? And so Nate is a great, is an expert at doing this. And so we're super excited to interview him about how Concurrent approaches this issue and some of the innovative solutions that they've brought to the table.
Absolutely.
Okay, Alan Darby, I'm here with Concurrent CEO Nate Lenz. Nate, welcome to the Buyer's Boardroom.
Alan, happy to be here, man.
Yeah. Well, one, thank you very much for taking time out. You guys are growing so fast over there at Concurrent. I know you're a busy guy, so I really appreciate you carving out some time to spend with us and our listeners.
Happy to do it, man. Yep.
Yeah. Well, why don't, so just for people who don't know you, maybe introduce yourself and Concurrent. Tell us a little bit about what you guys are building over there, and then I'll come at you with the topic of the day.
Absolutely. And, Alan, the work that you and Jacqueline do is near and dear to my heart. I actually started in the business in the succession and acquisitions group over at Raymond James in the home office there. So grew up in the practice management, business consulting, M&A side of the world. We launched Concurrent originally as an OSJ back in 2016 on the Raymond James platform. Really hit our stride from a growth perspective in the years that followed. Ultimately moved it to the RIA space in 2022. So over the last 2 years, I've been operating as a fully independent RIA. So I was excited to hear the topic of today and talking about OSJ valuation and what that looks like, because I think that very much parallels the path that we took in building our business and creating alignment with our advisors.
Yeah, well, I knew when we talked about this topic, I knew exactly who I wanted to have on, and it was you because of what you just said. So give me a little snapshot, though, of where Concurrent is today, just in terms of size, number of advisors, locations. Maybe just give us a quick glimpse.
Yeah, absolutely. So we are knocking on the door of 10 billion. I think we're officially at 9.8 billion in AUM today. We also, in addition to that, have about 14 billion of retirement plan assets. That is an area of strategic importance for us and expertise, is the corporate retirement plan business. And so we do ultimately work with firms on both sides of the house, both that are on the private client side as well as that are serving institutions within our organization. Those assets are spread across 39 office locations. And, something that's important to us within the Concurrent world is, one, again, all of our teams are independent. So you talk about the 1099 affiliation model. Our firms are independent. They're running their own businesses. We like to say that when a firm comes on board with Concurrent, they're not joining our business, right? They're not joining us. We're partnering with them to build their business.
Yep.
And that's an important distinction. And, from that perspective, I think what you'll see is that we're big believers in this idea of advisor centricity, right? That clients gravitate towards advisors who they perceive are like-minded, share their core values, are best equipped to serve their niche. We want to help put that up on a pedestal. So if you look at the Concurrent website, you'll see a number of different brands on there for our underlying partner firms. Looks a little bit like a NASCAR jacket, which I've always wanted to get made, right? I haven't yet, but that's important to us because of what we believe in. And, these teams are independent for a reason. We want to be supportive of the business that they're building, and we want to operate as a platform for their business and as well as a strategic investor in what they've created.
Great. Okay, so perfect segue, and I like how you started when you shared that you started as an OSJ on the Raymond James platform and now have moved to be an independent advisor. So here is the topic. It's the reality that a RIA or whatever structure they're in, they have built a business And within that business, the advisors on the team are 1099s. They're not W-2 employees. They each have their own. And the scenario that we're Jacqueline and I are talking about is, let's say we have a $10 million OSJ type model. There's 10 individual offices underneath that, each one roughly $1 million of revenue. The owner of the OSJ will come to me and have a conversation, and they are unaware that the present structure that they have is not the most favorable in terms of maximizing valuation. For the simple reality that, hey, we as the OSJ owners don't own the client relationship. The 1099 advisors do. And therefore, for me to be able to extract valuation, I'm going to have to go through a few steps to bind those clients to the central entity, let's say, in order for me to be able to monetize those. So, all right, that's the topic. So walk me through your thoughts on that, where you see solutions to that problem. And you guys, obviously, I think you probably recognize it to a degree. And I know you're doing things at Concurrent that help people that are in that scenario solve for that challenge. So walk us through it.
Absolutely. Well, and I think we're well equipped to talk about it because we suffered that problem ourselves, right? So if you go back to 2018, 2019, we're operating as an OSJ. I think at that point, maybe we had, $4 billion in assets, affiliated advisors all around the country, flying under their own flag, running their own businesses. We looked like a collection of disparate parts,
Yep.
right? And at the end of the day, we were really nothing more than a vendor to those firms.
Yep.
We provided compliance, transition support, some ops support. But at the end of the day, we were really nothing more than a vendor. And we recognize that to a degree. And so, some of the steps that we took within our own business to create alignment, right? And I'll use that terminology because you hit the nail on the head. The value lies in the underlying client relationships, right? And the goodwill these advisors have created with those relationships. Reaping overrides for providing services, right, has no privity or connection to those underlying relationships. So how do you create it? I think alignment is the key word here because it has to be a win-win, right? The idea of, hey, how can I extract value out of my affiliates, I think is, sure, right? That could be something you're pursuing. But at the end of the day, if it's not a win-win, if it's not also of huge benefit to them, then it's going to be a non-starter because they're independently minded. That's probably why they're using you in the first place. So for us, when we went to put pen to paper on our structure, and we do have a capital partner. We took on Merchant Wealth Partners. I believe you've had a few of the folks. I think Matt's been on the show.
Yep.
You know the team well, right?
Yep.
So they were instrumental in helping us formulate this model that we ultimately deployed back in 2020. But what we did to solve for that is we went to each of our advisor teams. We offered to take a minority equity stake in their business. For that equity stake, they received cash and equity in our business, as well as a tag along right into any future monetization. So the what's in it for them was, hey, come take some chips off the table if and where it makes sense for you, right? Get some equity in our business, which creates a nice level of alignment. But at the same time, you maintain control of your destiny up to and through any future event. And by having that tag along right, that option to sell more of your business later alongside of us, right, you're able to punch above your weight from a value standpoint because of the collective profitability, right, of Concurrent, the scale, the diversity of revenue we have paired with that alignment can attract outsized multiples. And what's really unique about our model is the fact that, unlike a traditional roll-up, the vast majority of that multiple expansion accrues to the advisor, right, versus to the firm. So I think that is a unique distinction here as well. But without that that alignment that we created, which was really transformative for our business, we went from being a vendor to being a partner. Again, I would make the same argument that you made, which is there's really not much value there. It's great cash flow.
Yeah, I get why they're doing it. It's easier to attract a 1099 advisor than it is to build a W-2 based model. It's just there's a lot of entrepreneurs out there who like their independence and they want to keep that relationship, but it's not the best for extracting value. So what you have built basically is a business recognizing that flaw, let's call it a flaw, in value, to permit, and say I'm that same scenario, that $10 million OSJ.
Yeah.
We could effectively say, okay, we're going to partner with Concurrent. So we're going to monetize a minority percentage of my business today in exchange for, as you mentioned, equity. So there may be some de-risking, but I'm going to take equity. But the biggest thing that you said is whatever I didn't monetize. I don't know what the numbers are, but let's say I monetized 20% coming into the partnership. So I'm retaining 80, but now I have the ability to transact with Concurrent later in what you call the tag along right. And if I heard you right, it's at a higher value, ostensibly the collective value of Concurrent, than what I would be able to monetize my individual practice for. That's all right. Yep.
Exactly right. Exactly right. When you think about, and I'm sure you guys talk about this quite a bit too, but you start to think about like valuation multiples, right? And if you look at, call it a individual practice selling to another advisor down the street, right? Maybe that the multiple on that business could be a, 4 to 7x type multiple, right? Which essentially where the debt service can be, covered by the cash flow of the business on available capital sources, which is how you typically see those individual deals kind of arm's length funded. You look at the traditional roll-ups that might pay, call it 8 to 12x, a portion in cash, a portion in stock. Under that structure, you're typically selling a controlling stake in your business, but you can get a premium in value on that. And really the key to them getting a return on the investment they're making is integrating that business into their processes, right? Driving additional growth, reaping additional profitability, and so forth. When you start to look at the comps for a business of our scale and diversity of revenue and profitability with the alignment that we've talked about, then you start to see valuations in the 12, 15, 18x type range. And so under our structure, what we're looking to facilitate for an individual practice is the ability to tap into those higher multiples, but not have to give up control to do so.
Yeah.
And I think that's what's really unique about the model.
No, well, I can tell you it's unique having it's sitting in the seat that we do at Alaris with some 80 now, I think, relationship with buyers. It stands out in a major way, and I think it's an elegant solution for these firms that have built this business on the OSJ type model. It doesn't have to be a broker dealer affiliated. We know we're using that term. It could be an independent RIA that has built their business with 1099 advisors, to be able
Absolutely.
to. And one thing we're not talking about is in the partnership with Concurrent, you're giving me all the autonomy and independence that I have today, it sounds like, but I'm able to access all of the tools, all the resources that I know you guys have invested in centrally. So it's like I'm getting the best of both worlds. I get access to all the stuff that I might not have the ability to go invest in or buy myself of a much larger $10 billion type size firm.
Exactly right. And I think it applies. It absolutely, the use case for $200 million practice. I think what you said is exactly right, which is, hey, they're able to tap into additional staff, technology, right? Pricing power, service power that they couldn't otherwise access. But I also think we've had a high degree of success with firms that are, 500 million, a billion, 2 billion, who, while they could in theory replicate what's been created, it's not the highest and best use for them to focus on that. And so by aligning with us and leveraging our platform and us being able to shoulder compliance and custody operations and finance and billing and tech, right, as well as being able to curate the menu of investment solutions, right, and bring additional value add services like planning and risk management resources, advanced and family office services resources, and help them drive growth, right, help them go and complete sub acquisitions, help them recruit advisors. I think that being able to tap into that platform at the price point that we're able to deliver it, it becomes a specialization conversation for those billion, $2 billion firms. And it also becomes a opportunity cost or cost savings conversation for the smaller firms. And when you string that together with an elegant partnership model like what we've created, I think it creates a very attractive value proposition. But you mentioned that $10 million firm that that we're using as the example here, right? As a buyer, when we're approached with one of those opportunities, what we really talk through with the banker, right, or with the firm themselves specifically is, okay, we need to create that level of alignment. So we're going to look at the profitability, right? Let's say it's a $10 million firm, and let's say the owner of that firm probably also has a book of business, right? Within that, maybe they're 2.5 million of the 10, and so they're reaping a 60 or 70% earnings before owner's comp margin on their book, and then maybe a 10%, right?
Service
gross margin on the rest. Yeah. Well, what we're going to do is we're going to kind of separate those parts. So we're going to say, okay, what's the override revenue being made on the platform? what expenses are associated with that, and what's that worth, right? And then at the same time, let's talk about that book of business where they own the clients. And then let's go out and execute upon a minority buy-in structure to the other affiliates. And if we can show that it's a win-win by creating that alignment, that upside, and again, I think the beauty of our model is the flexibility in it, our willingness to kind of sit down with a blank sheet of paper and start to think about, all right, are we ultimately acquiring the stakes in this business in a concurrent entity? Are we setting up a separate special purpose vehicle for the firm that we're partnering with to go and acquire those stakes, right? There's a lot of flexibility in the model, but the way that we typically approach those is we're going to go and help essentially learn from our experience in our playbook, go and execute that within their business, create that equity value, right?
Yeah.
And provide that
that's
tag
what you're doing. It's one, I love that you're willing to do that, because there are so many buyers who they're not willing to go through the effort, because there's a lot of steps in there. Like, I mean, if you have, in our scenario, there's me as the owner, and then I've got 10 advisors. That's 10 transactions that we basically have to pull off to get to this point of alignment and unification of the, but you literally extract massive amounts of value in that step. And so having is something that we don't do a lot of, but we have experience doing it, and I can tell you it's a heavy lift. So the fact that you guys understand it, have a playbook that you've done yourself, and have helped other firms do it with, is massively important. Well, awesome. Well, Nate, it's been fantastic. Appreciate all the direct responses and the candor. Congrats again on all the success you guys have had. I think when I first met you, you were less than 4 billion. So congrats on the massive amount of success. Next time I think we talk, we'll probably be at 20 billion as fast as you guys are growing. So
that's the goal. I hope we talk before then, Alan.
Absolutely.
But yeah, man, no, I appreciate you having me on the show here, and I think at the end of the day, this is something I've stolen from Mark Spilker over at Merchant, but we'll trade complexity and hard work for outsized rates of return. So when it comes to engaging in those types of conversations, to your point, it's not for everybody. There's an additional layer there, but it can create some outsized returns, right? Both for the seller as well as for us.
It's blue water. It's blue water. I'm just thrilled that you guys are doing it. And Mark is definitely someone worth quoting. So, all right. Well, Nate, thanks again. Appreciate it. We will be in touch.
Thanks, Alan.
Awesome. That was a great interview. I love hearing how he talks about that staged investment where firms are really able to balance that entrepreneurial spirit, but leverage the power of being part of a bigger brand and all the resources that come with that, but work towards full acquisition over time. It's really interesting.
Yeah. They're pros at it. He's fantastic and great communicator.
Yeah. Absolutely. Well, we've covered a lot today, pros and cons of the 1099 model. Obviously, where we land on that topic, but be fun to go through the buy down strategy with anyone listening right now that has a few of those advisors and wants to explore ways to roll those up and really maximize the value for everyone involved. I guess that's a wrap for today.
That's right. We've got some exciting news coming up here in the next few weeks that we're going to be announcing. I won't spill the beans just yet, but it's going to be, I think, industry changing. So we're super excited at Alara. So stay tuned.
All right. See you soon.
All right. Thanks.